Live from New York City this morning. Good morning, good morning. Earnings season begins right now. Equity futures on the S&P 500 down 0.9%. On the Nasdaq down a little more than 1%. We're 25 minutes away, 30 minutes away from the opening bell.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York, we begin with the big issue. Earnings season begins. Wall Street banks preparing for tougher times. Tesla cutting prices 20% to boost demand as the Fed lays the groundwork for smaller hikes.
Earnings.
Q4 earnings season starting now.
Expectations are that earnings will fall 2%.
-4%.
-6%.
When we look at tech and TMT, we think earnings are likely to come down another 15%.
It's not news that this quarter is going to be bad.
The bar is low, but the estimates for 2023 are still too high.
We think that margins are going to be under pressure.
Analysts still seem quite optimistic.
That's going to be the major headwind that equity markets have to contend with.
Tech companies have been a source of downward revisions.
The banks are all going to cost cut.
There's a lot of resilience in the banks.
Arbiter of whether or not we're going into a recession.
We need to gauge what level of losses are going to be tolerated by the markets.
We're actually hoping to use some of that weakness to actually buy it.
Earnings is one of those key questions that we need to find an answer to.
Let's get straight to Bloomberg. Sonali Basak. Hey, Sonali.
John, you're looking at banks who are bracing for an uncertain macro environment as well as uncertainties around both the top and the bottom lines. You're looking at JP Morgan, Jamie Dimon now talking to analysts on a conference call, talking about the net interest income expectations that did fall short for the year when you compare them to analyst expectations. Now, why is that? Because there's an expectation that with rates going up this fast, there will be more migration to savings products. But on the other hand, too, at JP Morgan, Bank of America, Citigroup, you do have headcount rising. You have JP Morgan executives telling analysts as well that there is still pressure on some costs, including labor inflation. So with all those bonus discussions that we've been talking about all year, you do still see compensation costs overall at the bank rising. Over at Citigroup, it is worth noting fixed income traders, they blew through the roof here. Remember, macro environments being as volatile as they are pretty good for these trading desks. Question is, does that continue? You have Jane Fraser saying in a statement announcing that the bank is very much on track to meet targets, the medium-term targets they've set out. Jamie Dimon also saying that they will meet their targets in the current quarter. Actually, they surpassed it meaningfully when it came to a return on tangible equity. But you do have longer-lasting questions here on where the money comes from in a tough year.
This all goes to the outlook. Looking ahead for another tough year, another 12 months. Jamie Dimon, the CEO, said this: "We still don't know the ultimate effect of the headwinds coming from geopolitical tensions, including the war in Ukraine." Goes on to say the vulnerable state of energy and food supplies, persistent inflation that's eroding purchasing power and pushing rates higher, and the unprecedented quantitative tightening as well. Just make sense of all of this for us. Jamie Dimon talked about a hurricane. The headwinds are still to come. Where are we now, Sonali?
Some of the headwinds are good. If you looked at the volatility and what it's done for trading over the last year, it's been a windfall. Of course, in the most recent quarter, you saw some pressure on them coming in below expectations on fixed income in particular. Where does that bode for some of the other banks and the money then that will be left to keep paying people at a higher rate as headcount grows? But as you're saying here, you're seeing it in part in the reserve builds. I think the reason this is interesting, John, is because you are seeing a lot of that reserve build in the card businesses, which are growing. So you are seeing in a very competitive environment, even in a tough environment, the banks at this point still leaning in on risk-taking. Similarly, in the value at risks in JP Morgan's trading books rising a little bit, that shows you a more competitive environment in which the banks are willing to take on some risk and potentially some costs that come along with that.
Morgan Stanley, Goldman Sachs, Tuesday. Long weekend here stateside. What are you looking for, Sonali?
I'm looking at trading. It's trading, trading, and more trading. But also remember something interesting to look at the side to supplement that trading is asset and wealth management. Goldman's restatement of their earnings show you that leaning on asset and wealth management as platform solutions / consumer businesses are giving you $1.2 billion worth of losses in the first 9 months of last year. So where does that bring total losses for the full year for Goldman Sachs? And can they show that asset and wealth that is growing as they pivot that business? At JP Morgan, there was a significant decline.
Shanali, thank you. We'll catch up with you a little bit later around the opening bell. Those stocks, JP Morgan down 2.6%, Citigroup down by not even 0.1%, Bank of America down by 1.8%, Wells Fargo struggling, as you can all see on the screen. With us now is Crossmark's Bob Dole, Nadia Lovell of UBS. Nadia, you made a move on the financials recently. Run me through why and whether these numbers this morning backs that up.
Absolutely. I mean, we recently downgraded financial to least preferred after strong outperformance off of the October low. We decided to do that into the strength. I mean, we're not surprised by the pullback that you're seeing in the banks today. I mean, historically, over the last year plus, we've seen weak trading around earnings after banks have run into earnings. We think that there's just earnings risk ahead. I mean, as Shanali has pointed out, the economic slowdown, we think that net interest income is peaking and will decelerate it. As we hit those peak in rates, deposit payers are rising, they're picking up, and that's going to pressure margins. Also, we think that the inverted yield curve will be problematic for spread. Loan growth is slowing. We're seeing that in the senior loan officer surveys, a tightening of lending standard. And credit quality, while that remains pretty benign right now, you're seeing the banks build reserve, and we expect more reserve bills as the credit environment deteriorate, those charge-offs pick up. And so we just think it's going to be a harder environment for banks, and they're not going to be able to pull those expense levers as they've been able to pull in past slowdown, given wage inflation and also the need to continue to invest in technology to remain competitive. So that's why we also downgraded financials.
Bob Dole, are you on the same page?
Yeah, largely speaking, I think a lot of the verbiage that came out of these earnings reports point to more difficulties going forward. Nadia did a good job outlining them. The labor cost problems, the problems with the inverted yield curve, what that does to net interest margins, lower income consumers using those credit cards. There are going to be some loan losses there. So their environment is tricky going forward. Now, he said that the stocks are pretty cheap relative to most measures. And so I don't think there's huge downside, but there's some adjustment going on here.
Nadia, just to go back to the broader earnings story, where are you expecting the biggest downgrades this earnings season?
Yeah, I would say the earnings expectation for the fourth quarter has probably come down enough. We've seen a massive downward revision since the third quarter. And so the consensus right now is calling for the first negative earnings since there is recovery, so 3% decline. But I think when you look across the board, we are concerned about the outlook. We think that that's where there's some concern, particularly on the more cyclical sectors of the market. I mean, can you believe it that the consensus is calling for double-digit earnings growth for financials, consumer discretionary, industrial? That's just perplexing to us to see near record or record earnings for these sectors. So we think that there's increased risk to those economically sensitive sectors as the economy slows down. We also even think that there's some risk even to tech.
So I understand why you like staples then. I understand why you like healthcare. Why energy? Nadia?
Oh, I'm sorry. Oh, I thought that was for Bob. Yes, in terms of energy, we just think that the drivers are still there for higher oil prices. They're still in place. We think that there's just a weakness that you've seen year to date will fade. I mean, when you look at Russian oil, that's still selling well below the $60 price cap that was put into place in December and half the global price. And it's becoming very difficult for Russia to sell its oil. We think it's going to become even more difficult when the embargo goes on refined products on February 5th. And then you have China reopening. That's going to put upward demand on energy. India still remains strong. So that incremental demand is going to come from emerging Asia. And so we continue to believe that Brent oil is going to get to $110 this year. And so that's why we continue to like energy in this environment.
22 repeat on the cards for you then, Nadia. Bob Dole, are you on the same page? Energy, staples, healthcare, the winners are 22, the winners are 23?
Yeah, largely speaking, I think the financials will have a better back half of the year. Healthcare is not all that cheap, nor are staples, although we like them. But I want to underline the energy call based on, among other things, the discipline these companies have in how they're using the enormous cash flow they have in terms of how many holes they drill in the ground. So I think these companies are changed from what they were in a positive direction.
Have these companies changed? United, American, Delta, these airlines year to date have absolutely ripped. I can go through some of the numbers for you. United Airlines up 36% over 8 trading days. Delta's down this morning off the back of numbers, but before that, Delta up by more than 20%. over the last 8 trading days year to date. American up by 32%. Even Southwest is up close to 10% year to date so far. Nadia, can you make sense of what's going on here? The first 8 trading days of the year and these massive gains we're seeing in this sector.
You know, we think that this market is still in a downward trend. I mean, the massive move that you're seeing in some of these single stocks and some of these industries is quite concerning to us because we just don't think that we're out of the woods yet. I mean, even the meme stocks are rallying. And so we think that the rally that you're seeing remains quite fragile. And we think that you're going to see it stall out around this 200-day moving average as we've seen in the past bear market rallies. We think that you're not going to really see an upward trend in the market until we get to a bottom of that economic data and earnings. And so we would expect a pullback in some of these stocks that have had massive rally in the last couple of weeks. We just don't think that there's enough downward earnings revisions, not yet.
Well, let's talk about how long we have to wait for that downward revision to this economy. Bob Dole, let's talk about the right here, right now. Neil Dutt of Renaissance Macro, a man who we've quoted a lot on this program over the last couple of months, is very constructive on where we are right here, right now. He said this morning: Europe is warming up, likely avoiding a technical recession. China is reopening. The Fed is stepping down from an aggressive rate hike pace, and fiscal policy is no longer a drag. He went on to say the Fed expects real GDP in 23 to slow down to 0.5% Q4 on Q4. And he finished with this: good luck with that one. Bob Dole, what do you say back to that?
So a lot of good points there. I think what we don't know, and perhaps what Neil's missing, is what effect what the Fed has already done will have on the economy. Second fastest rise in Fed funds rate in history. And that operates on the economy with a long and unpredictable lag. The effects, I think, still will be seen, and therefore the earnings risk, and therefore hard to see a lot of upside in the market.
Why do you think it's taken so long? Or do you just need to be a little bit more patient? How long do you think this takes, Bob, just to feed through?
Remember, they didn't start till last March, as you remember, John, and a lot of it came in the middle of the year, in the fall. Those lags are 6, 12, sometimes 18 months. So I think we're yet to understand what effect that will have. Not to mention, the balance sheet issue they have to deal with.
We'll keep building on this story. Bob Dole, Nadia Lovell sticking with us. Equities down by about 1% on the S&P. Coming up, Fed officials leaning towards smaller hikes.
Now, with forward-looking real rates positive across the curve, and therefore our feet unequivocally on the brakes, it just makes sense to steer more deliberately as we work to bring inflation down.
More on that still ahead.
Now, with forward-looking real rates positive across the curve, and therefore our feet unequivocally on the brakes, it just makes sense to steer more deliberately as we work to bring inflation down.
The Richmond Fed President Tom Barkin teeing up a downshift potentially to smaller rate hikes. The Fed's Patrick Harker supporting that move. The days of us raising by 75 basis points have surely passed. In my view, hikes of 25 basis points will be appropriate going forward. Mike McKee putting it all together for us. Hey, Mike.
Hey, John, I don't think, in all seriousness, that the debate is about the speed anymore. It's more about the destination. And there is a real disagreement between Wall Street and the Fed on the destination. Now, this week we've heard from Susan Collins, Patrick Harker, Tom Barkin, and Jim Bullard. And while they disagree on the speed, they're all saying the same thing about the destination. Take a look at what Harker and Bullard had to say yesterday. We need to get rates above 5%. How far above? We'll let the data dictate that. And the median dot said the policy rate would be somewhat above 5% at the end of 2023. That's what the Fed thinks. But take a look at what the market thinks. The market thinks the Fed isn't going to get to 5%. The Fed's forecast is 5.12% if you want to use the median dot from December. The outline there is where the market thinks the median is going to be. And that is not the same number. The market is also pricing in rate cuts for next year. The battle is going to be over the next couple of months. Is inflation going down fast enough, or is the economy turning badly enough that we need to see rate cuts? Jeff Gundlach, Double Line, said there's no way the Fed's going to 5%. The Fed's not in control. The bond market is in control, to which Minneapolis Fed Neil Kashkari this week in the New York Times had this rejoinder. they're going to lose the game of chicken. I can tell you that. So this is going to be fun to follow as the year goes on.
Well, we'll keep following it. But Mike, I guess at this point, what's the disagreement really over? Inflation? That the market seems to believe that inflation's going back towards target quicker than some of these Fed officials?
Well, there seem to be two camps. One agrees with that theory that inflation is coming down faster and the Fed will not have to react. And the other is that the Fed is going to push us into recession and therefore they're going to have to cut rates. Now, the problem with the first argument is even if inflation comes down, if the rest of the economy is doing fine, the Fed would not have to cut rates immediately. And they don't really want to. They'd like to keep rates higher for longer because they got down to zero for so long and had few tools to fight recession. So if they can, as somebody put it yesterday, normalize, I hadn't heard that term in a while, normalize rates to the 3 to 4% range, they'd be very happy.
I think we've forgotten what normal is. Mike, thank you, sir. As always, Mike McKee there breaking it down. Pace, speed and destination, where we end up. This came from Citi. Philadelphia Fed President Harker argued for a few 25 basis point hikes and accepting a slow decline in inflation, but we do not think he speaks for the committee. We continue to expect the Fed to reach a terminal rate of 525 to 550. That's the Citi view. Bob Dole, what's the Nuveen view? What's yours?
We think we'll get to 5 and that we'll be there at the end of the year. And we might even have a mild recession. Look, the Fed waited too long to get started. I think they're going to sit tight and let inflation fall once they get to where they're going to go. I disagree with the 4 handle for the terminal rate.
Nadia?
You know, I think if it weren't for the job market, we would say that the Fed has enough inflation data, the downward trend to pause. But we're just not there. So we're looking for 25 basis points in the next hike, and we're looking for a terminal rate to get around 5%. I think that the job market has been sending us very mixed signals. We saw wage growth moderate last week in the jobs data, but we're looking for more the ECI later this month, and also comments from corporation in the beige book to get a better sense of the labor market, because that data last week that we got was quite noisy. And so we do know that the labor market still remains really tight, and we need that to come back into balance. Not just about wage growth right now, it's also the labor market to come back into balance in terms of the demand versus the supply, for the Fed can feel comfortable in sort of pausing. But we think ultimately you get to a terminal rate of 5%.
Can we talk about that noise in the labour market just a little bit though, Nadia? What you see is unemployment at 3.5%. Wage growth softened a bit. Hours work came in just a little bit as well. Then I look at claims close to 200,000. I look at job openings and the quits rate, and everything looks pretty decent. Which one is it?
We would side more with in terms of the claims, the unemployment rate, and also the job openings. We know that there is 1.74 jobs for every person that's unemployed. That is just too tight. So even throughout the earnings season, we're going to be listening to hearing from corporations. What are they hearing in terms of how they seeing the employment picture? We know that there are layoffs in tech, but we also know that there's still tightness on the service side. So is that starting to ease? Because we think we need to see that before you can say that we are clearly in a downward trend in inflation.
Well, to that point, Bob, never mind recession. Are you seeing evidence of any real softening in this labour market in America?
Not at all. This is the Fed's biggest problem, as we've been stating, that the unemployment rate and labor report last week went from 3.7 to 3.5, only compounds their problem. There are just not enough workers out there, and therefore getting slowdown in wage growth is going to be really difficult.
Bob Dole, alongside Nadia Lovell. To the both of you, thank you on this equity market as we work through some of these themes. Equity market right now down about 1% on the S&P 500. Looking at this bond market at the moment, bond yields set up as follows, up about a basis point or so on a 2-year to 4.15, on a 10-year to about 3.46. Elsewhere in foreign exchange, we need to talk about this a little bit more this morning. Some major moves developing. And think about where we've been, where we were and where we are now. We've moved on the dollar by about 10% since late September. On dollar yen, 128 on the screen, we were at 150. Euro dollar, 95. End of September, now 1 away. You can take your pick at the moment. Take a look at cable. At the end of September, 103.50, and now it's through 120. Can that continue? Is that sustainable? And what does it mean for the path forward? We mentioned Caterpillar a little bit earlier this week. Caterpillar, all-time highs earlier this week. Take a look at the chart at where Caterpillar bottomed, which was the end of September, and where the dollar peaked at the same time. And this enthusiasm for this reopening story in China, encouraging people to get back into EM, back into the miners. Even in Europe, just some relief that it's not as bad as we thought it would be, just leading to a massive rip that you've seen in some of the European names. But some real pushback from the team over at Bank of America today on that theme out of Europe. And I can quickly bring up the note for you. It comes from the team over at BofA. In the European desk, they said this: the biggest upside risk is China reopening. But we think the impact on European equities from a US recession will be dominant. We see nearly 20% downside on the stock 600. They go on to say lower bond yields, widening risk premia, EPS downgrades and cyclical underperformance. And the team at BofA pushing back pretty aggressively against what you're seeing develop over in Europe at the moment. The stock 600 today up 0.1%. The DAX pretty stable and unchanged. The big story, the FTSE up 0.4% again this morning. Guy Johnson's going to talk about that a little bit later. Coming up, the morning calls, and later, earnings season getting underway. Baird's David George seeing a favourable setup for the big banks in the year ahead. Plus, Morgan Stanley's Jim Karen joins us for the opening bout. All of that still ahead with futures down about 1%. This is Bloomberg. 5 minutes or so away from the opening bell. Equity futures down here by 1% on the S&P, and the Nasdaq at the moment down by about 1% also. If you tee up the bond market, 2s, 10s and 30s, look a little something like this. Your 2-year yield up 2 basis points to 417. The trend through much of the year so far, though, year to date, yields coming in on a 10-year 347, back in October 433. You understand the trend. Yields rolling over, dollar a little weaker. Equity market supported to start the year at least. That's some of the price action. Let's get you some morning calls. 3 of them. Here's the first. Bank of America upgrading Caterpillar to buy, saying higher prices and better earnings will provide some shelter from the economic slowdown. That stock's been flying, up another 0.5%. Next up, Guggenheim downgrading Tesla to sell, warning that new incentives and recent price cuts will likely weigh on the automaker's margins. I'll get you some more Southside calls in just a moment on Tesla. That stock is down hard by a little more than 5% at the moment to 116.64. And your third and final call from RBC Capital, downgrading the US home builders, expecting numerous headwinds to drive significant downward EPS revisions. KB Homes, difficult couple of days. That stock is down by 1.5% to 34.40. They're 3 of the morning calls. Coming up, earnings season kicking off. Wall Street's biggest banks gearing up for a challenging year ahead. That conversation up next with Morgan Stanley's Jim Karen and Baird's David George. Looking forward to that. Your opening bell 4 minutes away. Equities down about 0.9%. 25 seconds away from the opening bout this morning. Good morning as we wrap up the trading week. 3-day winning streak on the S&P 500 after the close yesterday. That is the longest winning streak since November, believe it or not. That's how bad it's been. Equities right now down about 0.9%, looking to close out the week, maybe on a softer note on the Nasdaq, down by about 1%. There's your opening bout. Switch at the board and get to the bond market. Yields shaping up as follows. 10-year yields higher by a couple of basis points. 345.95 on a 10-year. In the FX market, the dollar trying to show some strength. Euro dollar 108.03. We're down about 0.5%. Crude approaching 80. $79 and about 10 cents, up 1% on the day. About 15 seconds into this, equities down by 0.8% on the S&P. On the Nasdaq, we're down about 0.8%. Also, one sector to watch at the open, the big banks. JP Morgan, Bank of America, Citi, Wells, kicking off earnings season. Abby has the price action. Hey, Abby.
Hey, John. Well, yeah, a bit of a disappointment here. We can see that all 4 of these big banks are trading to the downside on the unknown of the macro situation and what it could mean for revenue and profit going forward. Now, relative to JP Morgan, that stock is down about 3%. They had a disappointing net interest income guide of $73 billion versus $74.4 billion. That was the estimate. Citigroup, interestingly, the stock had been almost higher earlier, right now down about 1%. Their FIC trading, they actually smashed that number. The iBanking and equities a little bit light, however. Bank of America, those shares are down 1.2%, relatively clean quarter, beats in net interest income. And then rounding it out, Wells Fargo doing the worst at this point, down 3.4%, surging expenses. They miss revenues. revenues slightly. They do expect the economy to worsen. Now, if we take a look at net interest income, we are going to see here, or excuse me, the provision for loan losses much larger than expected. Not a great sign for some of these banks. JP Morgan leading the way there. And then finally, price action, John. You know, it's interesting. So we have these banks trading off today. All four of these banks on the year over the last year down about 20% or more. But take a look at this rally that we're seeing in JP Morgan and the banks overall. The banks overall out of that October low up about 20%. But JP Morgan ahead of today had been up closer to 35%. So we're seeing this dip. It's going to be interesting to see if it continues. But that trend to the upside right now, it looks relatively strong.
It's in a massive rally in that name since October or so. Avi, thank you for that. Equities more broadly about 2 minutes into the session, down about 0.7%. No real drama here. Hearing a lot from Jamie Dimon, warning some investors of further economic uncertainty and saying this: we still don't know the ultimate effect of the headwinds coming from geopolitical tensions, including the war in Ukraine, the vulnerable state of energy and food supplies, persistent inflation that's eroding purchasing power and pushing rates higher, and the unprecedented QT as well. Shanali on top of it all. Hey, Shanali.
John, not surprisingly here, as you're seeing those economic uncertainties really start to bake in, you are starting to see some very interesting cracks in borrowers when you think about consumers as well as corporate customers. Let me draw those out for you really quickly here, because charge-offs over at Citigroup, for example, rising. Remember, they are still coming off historical lows. These are not crisis era types of charge-offs we're seeing, but they are indeed starting to rise. Remember, this is as credit cards largely have risen very meaningfully, especially after the pandemic in more recent quarters for both Citigroup and JP Morgan. So when you see these reserve builds, that's really what you're talking about here. It helps them ink that net interest income that you like to see so much. For JP Morgan, though, however, they are going to likely come in short of expectations for the year. Part of that is because you're watching really deposits start to come back, especially in some of those higher yielding products like CDs. I will also say, interestingly, over at Citigroup, you are expecting a higher than expected revenue for the year. And what Jane Fraser is saying is still the phase one of her turnaround story. Because it is indeed phase one, John, you are also likely to see higher expenses than expected. Overall, on the conference call over for JP Morgan, you are hearing Jamie Dimon and you're thinking, is he sitting there penny pinching here? Because he's getting questions about expenses as well, and he is drawing out his dollar in, dollar out analysis for analysts here. Every branch we open and every banker they hire, they have to ask themselves what those dollars are coming in per those people.
Shanali Basak, thank you. Just on the financials, Ken Leon of CFRA saying financials can stay strong even as the economy cools.
I think if you have an environment of not too hot and not too cold, it's a great environment for financial sector, particularly banks, where the expectations are not as high as perhaps other areas that have benefited with a strong bull case scenario. Banks actually are in a pretty good position for performance for 2023 as we see it.
Pleased to say that David George of Baird joins us now. David, we often do this every quarter, so thanks for being with us, sir. I know that you're neutral on JP Morgan. You were neutral on Bank of America. Does anything about today's numbers change that?
Hey, John, good to see you again. Happy New Year. No, not really. I think certainly a lot of your comments this morning, it's totally ring true. But I think it's important, and I know the stocks are down today, to have some perspective. JP Morgan came in, we wrote in our note, the stock came in really hot. The quarter was fine. They made $11 billion. You think about everything that you and Shanali were just discussing, they earned $11 billion in the 3 months. So fundamentally, despite all of the uncertainty, all of the macro fears that are out there, it's still a fantastic business model. And from our perspective, it was just a valuation issue going into earnings more than anything else, rather than any meaningful fundamental issue.
David, something you said coming into earnings season, reasonably good, the setup versus the broader market. Why is that?
Yeah, so coming into 2023, to give you some context, we have a fairly constructive view on financials. And one of your earlier guests just kind of mentioned the bars a little lower. If we think about a year or so ago when maybe we were having this conversation, John, the stocks were 25% more expensive. And the earnings outlook is actually better today than it was a year ago. And that's a function of more aggressive Fed tightening than maybe we would have expected a year or so ago. So the revenue outlook is actually pretty good. Now, it's really a function of what does the credit environment from here look like and how does that unfold? And we're of the view that it doesn't have to be binary. It doesn't have to be a soft landing in one camp and the great financial crisis in the other. We're of the view, and we're generally calling the 2023 the year of normalization in all things, and really kind of going back to 2019 as a core growth guide since we've had so much unusual activity and between Fed stimulus and taking that away. We're of the view that things are going to normalize really throughout the economy and the banking system as well.
David, when you say normalize, what does that word really mean? What does normal mean these days?
Well, we try and view cyclical stocks like banks, John, through a normalized lens. And what that means, more than anything, is what is normal from a credit perspective and credit costs in general. So JP Morgan, as an example, they only had 32 basis points of credit losses. What we would consider to be normal would probably be something in the order of 50 basis points. So it's while we're fully on board with the notion that credit is going to deteriorate, it doesn't mean that we're going to have a GFC-like scenario. Banks take risks, and they're expected to have losses. That is actually part of the business. So I think sometimes we get too caught up in the day-to-day delta, as it were, in terms of credit, as opposed to just thinking through the cycle, what's normal, and taking more of a kind of intermediate term view as it relates to that.
I'm about to get caught up with what's happening on the screen right now. Wells Fargo down by a little more than 4%. That's a stock you like. David, what happened this morning?
Yeah, it is. So a couple things. The expenses were higher than expected. They're taking some significant operating losses, which we think are to try and get in front of some of the regulatory issues that are certainly well publicized. And their net interest income outlook for 2023 was a little disappointing. And thematically, one thing that we've seen so far is the net interest income outlooks for the full year are a little light relative to where I think consensus kind of came out. And that's a function, John, of deposits and low-cost deposits moving out of the system into higher-cost alternatives. And that NII impact may be a little more muted than maybe some market participants expected.
Is that another way of saying they might be competing for our deposits sometime soon, David? Are they going to have to pay up for that?
Well, I think that's yeah. To answer your question, yes, I think that's going to be an industry-wide phenomenon as we go through 2023. I think there's going to be more of a food fight for deposits, and the days of paying 1 basis point for funding, we think, are generally over. And so that's going to be thematically something that we keep an eye on for sure.
I think a lot of us are happy with that. David, thank you, sir. David George there of Fed, thank you very much. We brought our equity market about 9 minutes in, down 0.9%. Jim Karen of Morgan Stanley joins us now. Jim, I just want to go straight to earnings with you. You look at the data, you look at what's happening with companies, and I know you see a bit of a problem ahead for profit margins. Why is that?
Well, look, I mean, I think it all really stems from what's likely to happen with the broader economy in terms of GDP growth. If you get slower GDP growth, you get, consumption, comes down as well. Consumption brings down GDP growth. And when we see the labor market, which we think is starting to soften up a little bit, that means consumers have less money. So what that then means is that corporations cannot pass on higher costs to the consumer. The consumer is just not going to be able to pay those costs. So what then that feeds into naturally is tighter profit margins. Once you start to get laying off more workers and controlling labor costs. And I think this is really the macro backdrop that we have to worry about in terms of thinking about this negative feedback loop that can start to work through the economy in 2023. And as I like to say, well, don't like to say it, but 2023 could be worse for Main Street than actually for Wall Street, because this is the environment where I think the consumer actually starts to feel the pinch of the long and variable lags of Fed policy.
So almost like the reverse of last year, Jim.
Yeah, in many ways, we can think about it as the reverse of last year. It's really a lot of these long and variable lags that are really starting to come home here. So look, I mean, I think the Fed's in a very interesting position in terms of how we think about, how we think we're going to grow in 2023. In some cases, I think maybe some people might consider the Fed as chickening out on their inflation mandate. Look, inflation is coming down. We had a month-over-month CPI print yesterday come out negative, and we haven't seen that really since 2020. So, and that was just before the pandemic. So essentially what we're starting to see, our price pressure is starting to come down, and I think that's good, but it's coming down at the expense of slower growth. And also potentially weaker employment, weaker labor, and also declining wages. So all of this then feeds through to GDP growth, to earnings, to profit margins, and that's the cycle that's ahead of us. And John, I think the real question though is how much of this is in the price? How much of this do we think is actually already there, and will we do worse than what people are already thinking? Because many people think the first half of the year is really where the adjustment's going to take place.
So, Jim, here's my market question. What makes less sense, the S&P 500 near 4,000 or high-yield spreads near 400?
I would say high yields. Well, okay. Well, this is good. Now let me frame this. I'm actually more positive on high yield, and so I would say the S&P makes less sense. I would argue that high yield spreads have more likelihood to do well, meaning tighten. High yield has more likelihood in higher quality risk adjusted returns context to actually perform better. And the reason is because if the Fed starts to pause around a 5% policy rate, maybe they go in February, maybe they go one more time in March, and then they're done, then what that means is that the default risk cycle is going to be much, much more muted. So maybe you get that soft, bumpy landing. Look, I'm getting 8% yields, little over 8% yields in high yield. Spreads are a little over 400 basis points, or about 420 basis points. So I get that the spread may not come in a whole lot more, but I'm still collecting an 8% coupon. So maybe those yields actually start to come down, and essentially, which would also mean the Treasury yields come down a bit as well. But I'd rather collect that 8% coupon with more certainty of an easier default cycle than try to play I'm going to guess what equities may or may not do. So the way that we're structuring it in our balanced portfolios is we're trying to think about those two risks and try to find which is the better quality risk. And I'm leaning towards thinking that high yield is that higher quality risk.
Hey, Jim, stick with us. Jim Caron of Morgan Stanley there, looking at high yield over equities right now. Your equity market at the moment, about 13 minutes in, down 0.8% on the S&P and on the Nasdaq too. Coming up, Tesla cutting prices by up to 20%.
It's a great company. We just don't believe it's a great stock right now. It's unclear how long the price cuts are going to have to keep going.
And that conversation up next.
If you have a stock that's down 70%, I think that's the beginning of a train wreck. It's a great company. We just don't believe it's a great stock right now. It's unclear how long the price cuts are going to have to keep going. And why would you jump in now? Why wouldn't you just wait to let the dust clear? Because I don't think it's going to get away from you.
Tesla slashing prices by up to 20% across the US and Europe in a bid to boost demand. Analysts on Wall Street starting to sound the alarm. Evercore writing the following: there will be a significant impact to Tesla's near-term gross margins. The math depends on how long these new prices last. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, Jonathan. Tesla down 6%, meaning it is now down 6% year to date. This focuses largely with more significant discounts on Model Y, 20% on the base Model Y here in the United States, as you said, or $21,000 off the more expensive higher-end performance model. There's more modest trims in price to the Model 3. What's so interesting is the emphasis Tesla is putting on that $7,500 incentive, which will last through to March of 2023. I think what's so interesting about the sell-side analyst reaction is not that this will result in a hit to gross margin, but actually that they see a pretty significant miss on that margin when we get fourth quarter earnings in a few weeks' time. This is coming off the back, of course, of price cuts in China, multiple price cuts. I think the debate now around whether there is a demand issue has probably gone out the window, but it depends how long these price cuts last. And indeed, it can be a lever that spurs demand. And so I think we want to know the duration of the price cut and then what volumes will be going into 2023. There is some skepticism from some in the market that target of 50% average annual growth on production and deliveries will be achievable for the coming years.
Let's start with the bull case. Tesla at 116. Down 5.8%. Dan Ives of Wedbush outperformed still 175. Said this: we believe altogether these price cuts could spur demand deliveries by 12 to 15% globally in 23, and shows Tesla and Musk are going to be on the offensive to spur demand in a softening backdrop. That's the constructive view. Let's put that to one side. The bigger issue for investors right now, Ed, is how to value the company. And you saw this from Wells Fargo. They ask the question of the moment for Tesla. There is a growing debate among institutional investors on how to value the company. Is it auto or is it tech? Which one is it?
Yeah, I mean, I go straight to 12-month forward earnings. I think we're around 25 to 30 when it comes to 12-month forward earnings, right? There's an interesting, way of looking at this, that if you applied a similar multiple to Tesla that carries for Ford and GM as an example, then the market cap that Tesla currently has would come down very significantly. You and I had this discussion many times over the last 3 years, right? That a lot of the valuation was put because of full self-driving, the future promise of robo-taxi. Now that the economy has changed coming out of the pandemic, there is a realization that Tesla is starting to be valued simply as a company that makes cars, and that demand for those vehicles is starting to pull back slightly. But there are many that are still bullish on the longer term about the software part of this business.
It's been a difficult year for both autos and for tech as well, for that matter as well. Ed, great work as always. Tesla over the last year, you can see it there on the screen, down 66% over the last 12 months. We are about 20 minutes into this. The equity market's down about 5 or 6/10 of 1%. I want to get a final thought now from Morgan Stanley's Jim Caron. Jim, I think you've been out front on this. You don't talk about defense, you talk about balance. Can you tell me the difference right now as we look ahead to a pretty uncertain 2023?
Yeah, so look, I mean, many people think about being defensive as ways to avoid risk or ways to participate in assets that just do not have a large movement in the markets, just tend to be lower volatility. Now, what I think is very, very important is that we balance those risks, meaning that we are in a situation where we have fat tail risks, meaning that we could get a hard landing, you could get a soft landing, and good things happen, and we have to balance those two things. So we can start by looking at cash, for example. We can start by looking at short duration instruments and funds in that area, and say that yields are pretty good. 3-month T-bills yield above 4%. That's a good place. Now, do you balance that by owning equity and high yield and other assets as well? Because if you're in an environment where you do get a risk-on move in the markets, the one thing I think is a risk is risk on. And I want to say that very, very clearly. Risk on is a risk. And the reason I say risk on is a risk is because people are underinvested in the markets. If you look at what is in money market funds these days, it's almost $5 trillion. So if you get a very positive move in the market, you can't afford as an asset manager, as a money manager, to move to miss that move. So you want to be in safer assets like short duration, high quality fixed income assets. But you also want to balance that against owning things where, if rates come down, if we stabilize, if we get a soft landing, asset classes like high yield, credit, and some high quality, maybe value orientated equities can also do well too. You want to be able to balance those two risks so that you reduce the risks through diversification. So the difference between defensive and balance is that balance reduces risks through diversification and keeps an eye on risk controls in that sense.
Hey, Jim, this was great. Jim Caron and Morgan Stanley. Jim, thanks for sticking with us, working through a lot there in both the equity market and in fixed income as well, and a little bit of portfolio construction at the end. About 23 minutes into the session, equities down 0.5% with a sector price action. Here's Abby.
Well, John, we are certainly coming off the lows. The S&P 500 now down about 0.5%. We have two sectors that are slightly higher, healthcare and staples, defensive sectors to the bottom, not surprisingly financials, but John, down just 1%. Some of those banks down less than 1% at this point, so it's going to be interesting to see how this day plays out. Tech right in the middle, down about 0.8% on the week, though, John. This is interesting. So we're looking at a second up week in a row for the S&P 500. Year to date, we have the discretionary space very strong, up 6.5%. You can see Amazon is a big contributor to that. Home Depot, too. But take a look at Tesla. Yesterday, I believe Tesla would have been about flat to up on the year, but now on the 20% price cut that you all were just talking about, down 5.4%. Super interesting. At its peak, Tesla, 20% of that sector, now about 10%.
Abby, thank you. Some big moves there for you. The broader market, no real drama, down 0.5%. Up next, your trading diary. 26 minutes in, equities down 0.5% on the S&P, on the Nasdaq down 0.5% also. Just a little softer, lighter negative as we close out the week. That's the price action. Let's get you the trading diary. Coming up, UMich Consumer Sentiment Survey at the top of the hour. More Fed speak, Kashkari, Harker on deck. Looking ahead to next week, US markets closed on Monday. Bank earnings picked back up with Morgan Stanley and Goldman. Plus, we'll hear from Fed President John Williams. from New York, that does it for me. For those of you stateside, enjoy the long weekend. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This is Bloomberg.